A 401k caps you at $24,500 a year. A Roth IRA caps you at $7,500 and shuts off entirely above certain incomes. There is one investment account with no contribution limit, no income limit, and no penalty for early access. Today, the taxable brokerage account, what it gives up, and where it actually slots into your real plan. Welcome to Fiscal Fluency, the language of wealth. Taxable brokerage is the most flexible account in personal finance and the most misunderstood. Let's translate what it actually is, what it costs you, and when to use it. A taxable brokerage account is the simplest investment account that exists. You open it at a broker, Fidelity, Schwab, Vanguard, others. Fund it with after-tax money and buy whatever you want. Index funds, ETFs, individual stocks, bonds. There is no annual contribution limit, no income limit, no early withdrawal penalty, no required minimum distribution at 73. You can pull money out tomorrow. That flexibility is the entire selling point. A 401k locks money up until 59 and a half. A Roth IRA locks the gains up. A taxable brokerage locks nothing. The trade-off, and there is one, is taxes. Here is the cost. When you sell an investment in a taxable brokerage for more than you paid, the difference is a capital gain, and it is taxed. How much depends on how long you held it. 1 year or less, short-term capital gains, taxed at your ordinary income rate, up to 37% federal. More than a year, long-term capital gains, 0% if your taxable income is under roughly $48,000 single, $96,000 married, 15% for most middle and upper middle earners, 20% at the top, same investment, same gain. The hold period decides whether the IRS takes 37 cents or 0 cents of every dollar. There is a second tax most people forget. Dividends and interest paid into the account are taxable the year you receive them, even if you never sell a share. That is the silent annual drag of a taxable account. So you trade tax efficiency for flexibility. Inside a Roth IRA, your investments grow tax-free and you owe nothing on the way out. Inside a 401k, they grow tax-deferred and you owe ordinary income tax later. Inside a taxable brokerage, you pay tax on dividends every year and on gains when you sell. That tax drag is real. Over 30 years, it can shave a meaningful slice off your ending balance compared to the same money in a Roth. What you get in return is total optionality. Need a down payment in 3 years? Pull it out. Want to retire at 50? Bridge the gap from 50 to 59 and a half with brokerage money before the retirement accounts unlock. No penalties, no paperwork. This is why brokerage almost never comes first. The standard priority order. 1. Contribute to your 401k up to the full employer match. That is a 100% immediate return you cannot beat anywhere else. 2. If you have a high-deductible health plan, max your HSA, triple tax-advantaged. 3. Max your Roth IRA, $7,500 a year of tax-free growth. 4. Go back and max the rest of your 401k. 5. Then, with anything left over, fund the taxable brokerage. The brokerage is the overflow, the bridge, the flexible bucket. It is not the first stop. And once you have one, the move is to hold tax-efficient assets there, broad index funds, ETFs, and keep the high dividend or high turnover stuff inside the retirement accounts. This is education, not financial advice. Tax brackets, contribution limits, and capital gains rates change year to year. Verify current numbers before acting on any of them. The investment and contribution log inside the Fiscal Fluency ledger tracks all 5 tiers in one workbook. Subscribe for the rest. Stay fluent.